My name is John Richter. I'm one of the instructors at Financial Mechanics. Glad you could join us for this webcast today on financial asset accounting. We're hoping you'll find today's session useful, not just for improving, hopefully, your understanding if you're kind of new at this stuff, but also for those of you who have more experience with financial asset accounting, you might pick up a few tips on just how to explain things to other folks. Let's see, before I get started, just a few administrative items. First, we'll be recording today's webcast, so you guys don't have to scribble too furiously. You can review it and watch it after the fact. We'll also be presenting the slides up for those of you guys who are entitled to get the downloads. And finally, regarding questions, I'm enthusiastic about you guys chipping in on your questions box. You'll see it there on your webcast sort of dialogue. So go ahead and test that out when you get a chance and interject questions, comments, stuff you'd like me to review over again as you see fit. So with that, let's get started. Let me have a look at today's outline. First off, what we're going to do is first I want to set the stage. I want to sort of understand kind of the framework that we're going to start from, which is a fixed asset starting point. Just kind of set a very simple financial financial model of some business. The next step of things then is to sort of talk through the main features of financial asset accounting, often kind of referred to in one form or another as sort of sale leaseback types of things. Then I'd like to kind of get on and drive into a model, open it up, and actually move it from fixed asset to financial asset and kind of talk through the actual modeling implementation, because that's a good fraction of why some of you guys are on this call, is to see the actual modeling and implementation. And finally, I'd like to take a look and kind of analyze the differences between the fixed asset and the financial asset and put up some comparative graphs and things like that. So before we get into things too far, I think it's important to emphasize that there are multiple accounting standards that have different variations on the financial asset accounting subject. To start with, there's the traditional U.S. capital lease type accounting, which is also kind of reflected in a very similar, albeit pretty out of date now, UK standard called SAP 21. There is probably the most common, certainly for those of you guys on the call that are doing PPP and P3 transactions, depending on which terminology you want to use, in the UK is FRS 5, the finance debtor-based treatment. And of increasing importance and under a lot of review these days is the international IFRS implementations, including some guidance for the UK implementation of IFRS known as IFRIC 12. Today, we're only going to focus on FRS 5. So to summarize and kind of help me and let you guys know what is kind of by exclusion not for today, those other standards are off topic, if you will, FRS 5 only for today. Service income recognition is a topic that relates to taking what we'll see as the residual service invoices and adjusting how income is recognized on them. And we are not going to handle that in today's webcast. We are not going to presume any ongoing capitalized expenditures. That in itself introduces some further accounting and, frankly, modeling implementation issues, which we will not be talking about today. No discussion of the knock-on and effects of whether tax treatment might follow or otherwise be adjusted by a change in the accounting treatment. We're going to avoid any discussion and modeling of the construction period accounting of financial asset based projects. It's particularly important, of course, for greenfield project finance to have a grip on that and we are not going to cover that today either. Indexation and indexation weighting is an important topic when it comes to these commercial structures that are often the genesis, if you will, of financial asset accounting that have to do with indexing different parts of the revenue stream with different percentages. And we are not going to kind of go through that. Some of you guys will know precisely what I'm referring to on that. For those of you not, stay tuned for further sessions. And finally, no consideration of residual value and how that would be treated. Again, another subject of relevance to some projects and project accounting. We are going to assume that we are scrapping our project, our company, at the end of the sales contract term. So if any of that looks of relevance to your current job or things that you feel you might have to be contending with over the upcoming months or weeks, let us know. Kick us a note and we will react to that. There are other webcasts in the hopper. So, our starting position. Well, if you want to consider a position that's likely to be the most representative of what I've called a pure financial asset treatment, we need to start with a very specific, very simple, very clean scenario where we have this widget plant, a company, special purpose vehicle, maybe special purpose company, depends on your terminology, single asset firm that in our case cost $200 million to construct, that we financed $160 million with debt, $40 million with equity. We're operating at $10 million a year, which is indexed or otherwise inflating at 4% per annum. Crucially, we just have a single customer. There is not a wide market for our widgets. We have a single dominant customer that we rely on. And with him, we have a 20-year sales contract where our customer is guaranteed to purchase any of the volume that we produce at a fixed price that is also indexed in our example here today. Okay, so a real fixed price of $60 a unit indexed with inflation. And finally, as I commented earlier, we're going to scrap this plant after 20 years with no residual value. We take a look at this idea I have for a vision from the accountants and this sort of a walkthrough of a sale leaseback transaction. We start with our company SPV and we have a look over at our single customer. It may well be a government. It's one of the more common reasons to switch to financial asset accounting. Dominant player who calls us up and says, I want you to sell me your widget plant so that you will no longer own it. And you kind of nod your head because you don't have too much choice with a dominant single customer. Again, this is a vision from the accountants. It may not, well, almost certainly it's probably not the legal circumstance. There's no physical sale of the plant. You'd expect to get some money back from that sale, which does beg the question, what is the sale price? What are you going to sell it to the customer? He's a pretty tough negotiator and he's prepared to only pay for it at book value. So if it costs you $200 million to build, you get it done, you only get that amount of money. There's no profit margin on the fact that you took some construction risk or anything like that. Calls you up the next day with some further bad news. He says that he doesn't have any money. You're going to have to lend him the cash that he needs to use in order to buy the widget plant from you. So kind of seller-based financing, if you will. And for that money that you send him, which of course will cancel out with the, if you will, the sale money, so the cash flows don't exist, but for that money that you're sending back, you'll get a loan note or a lease back from the customer. So you start to see that concept of sale lease back. We're going to talk more in terms of this being a customer loan, if you will, but it gives you a sort of sense of what the traditional framework structure and why it's termed the way it is. Well, with that loan, we've got to consider what terms are we going to provide our customer. That would include interest rate, repayment term. In this case, you might argue that we'll allow him to repay over the length of the sales contract. God only knows what we're going to use for an interest rate. What repayment profile are we going to let him repay his loan in? What's the amortization of our financial asset, that loan on our balance sheet now with the SPV, that loan note that we've got back? And finally and crucially, we need to be clear that the debt service that our customer is going to be paying, meaning interest and principal on his loan, is going to be paid from or out of the invoices he otherwise is paying us for the widgets that we have sold him. There's no additional invoice. Matter of fact, physically, there's no change in the contractual structure as far as invoices or price per widget or anything else. This is a hypothetical accounting transaction. And hence it would, in theory, have no effect on cash flow, except with the provisos that we aren't going to talk too much about today. If the tax treatment were somehow affected by this accounting change, or if the SPV under the fixed asset treatment was hampered in its ability to send out dividends because of lack of sufficient accounting profit, the change in the accounting treatment might change that picture and therefore change the dividend cash flows. So that's kind of an overall picture of what is going on with respect to this hypothetical accounting transaction. And it's going to underpin how it is that we're going to shift from a fixed asset based set of financial statements to a financial asset based setup. So I'm going to hop into the financial model and take one step at a time here. We're going to start by simply selling the widget plan. Okay, so of course we'll no longer have depreciation in the P&L, and we'll no longer have that asset on the balance sheet. So let's just flip over to a very simple financial model, have a look at what we've got. Here's our widget plant here, starting with our financial forecast at 30 September 2010 with $200 million book value. That's going to disappear and be replaced by a customer loan. But what I've set up and kind of preset here is a switch that will, if I look at this formula here, unless that switch is 1, there will be no fixed asset, that the total capital basis of $200 million will not be reflected in the fixed assets. So let's change that switch over to 2, get ourselves sort of started. Hop back. So now I no longer have any accounting depreciation. I could take a quick look at that line just to confirm I am completely zero. And by definition, no initial balance, no depreciation, no anything going on, and nothing here. So if we move back to the financial statements and do a full recalc of the model, we've effectively sold that asset. And that's a start. Now, of course, you're going to note that the balance sheet doesn't balance. We've kind of gotten rid of this asset without replacing it with anything else. So the next thing I'm going to kind of do here on my checklist is to set up some what we call placeholders. I'm going to take a look at what the customer loan, just a general term I'm using for this asset, our loan to the customer. And we're going to set up some placeholders both in the balance sheet and in the profit and loss statement. So let's just kind of get that job done. Let's insert a row here. Pretty simple stuff. I'm just going to call it customer loan. I'm going to mark kind of lines of interest here, green, a little light green here, just to sort of give a little bit of focus for you guys. Okay, and up, you've got a customer loan. You're going to get interest income from that customer loan. I suppose I'll just say interest income. And of course, the accountants will want to see any financial income below EBITDA. And because of this split in the way the income is kind of set up and what's left, and just generally for now, I'm just going to note that the widget invoices themselves are open to question. We're going to come back to that in a few minutes, but for now I just kind of want to put an alert in here that we are not necessarily going to book all of those widget invoices, almost certainly not, in fact, as revenue. For those of you concerned that my simple insertion of rows is somehow not going to have those placeholders properly reflected, if you will, rest assured some functions are there and they're all set ready to go. So having set up those placeholders, I'm going to flip back to my sort of punch list here. We're going to need to go ahead and calculate those customer loan line items that are relevant. And as you guys can appreciate, that's going to be interest income that we talked about. Again, don't forget, paid out of invoices or paid from invoices. Somehow that customer is going to have to repay his loan. Again, kind of netted from the invoices. And what's left of the invoices after you take out the interest and loan repayment elements is what we're going to call residual service-related invoices or income. Let's just see what we can do with that. What I'm going to do is take this template worksheet, which is a very sort of blank thing with some components on it. I'm going to kind of control, drag that up here, create a copy of that sheet. And I'm going to create effectively a new chapter in this worksheet called Customer Loan Worksheet. What we're going to have on this worksheet, because it's a loan sheet, is a balance. I'll get to that here in a second. I'm just kind of setting up what I'd expect to see. Some interest calculations and principal repayment. Hopefully I can type this morning. This is sort of just a pre-built, you guys will recognize this from your main training. This is just a pre-built 7-line corkscrew, which allows us to reuse the structure over and over again. So I have a customer loan. You'll remember that we had a look at that little block that we had for switching the treatment, if you will, of what happens with that capital basis, that $200 million, depending on the accounting provision. So I'm going to take a copy of that block, throw it in here. And here what I'm going to do is say customer loan initial balance, where if it's 2, we're going to pick up that $200 million. And then I'm going to use that to feed the corkscrew, if you will. So I'm just going to create a link to that calculation. And now I have a customer loan, not very exciting, because, if I look at it, it's just kind of at $200 million because there's no repayment on it. But at least it's a start. And we've got a sort of the starting position of a balance. This extra stuff left over from the template sheet we generally have as our standard financial mechanics stuff I can get rid of. All right, interest. Well, we talked about one of the main loan terms needs to be some sort of customer loan interest rate. And where that number comes from and its convention, how it's compounded and all that kind of stuff, as with all of the parameters that relate to financial asset accounting, it's going to come somehow from the accountants. And I'm just going to go ahead and throw in a 9% as a maybe sort of typical rate. We're going to apply that on the brought forward balance of the customer loan. So let me create a link down to that. And because that's a link from later in the book, you guys will know, we'll mark that as a counterflow. So customer loan interest income note that we have a semi-annual financing model here as our sort of starting position. Therefore, if I've got a semi-annual coupon rate, there's no expectation that we're going to change this to quarterly. So I can reasonably leave those embedded constants in there. We can talk more about fast standards another day, but here's my customer loan interest income calculation based upon a loan that is not being repaid. Therefore, I'd expect it to be pretty uninteresting as well. We've got $9 million a period based upon 9% on 200 million on a semi-annual coupon basis. So if you will, 4.5% per period on 200 million. Now, when we finally get this repaid, this is going to be the correct figures, if you will. So here is my line that goes into the profit and loss or income statement, if you prefer. So I'm just going to create a link for that. Okay, into the financial statements. So we've kind of ticked that off. I've gotten rid of the green there. And you guys might reasonably sort of say, well, John, we should go ahead and get that closing balance here of the customer loan and create a link to it. Okay, so that we have that. And if I do a full recalc of the model, what we're going to see is that we're out for reasons that will become more clear that are beyond just the fact that we aren't repaying the loan itself, and have fundamentally to do with this question mark that we've got here. Right now we're recognizing interest income, but we haven't really properly reflected what the, if you will, the trading revenue is going to be on this financial asset based setup. Let me hop back to my customer loan sheet and see what else we can do. So interest is done. Time to repay it. You guys will know that normally we detest canned Excel functions. Let me use the term amortization. This is an asset on my balance sheet. So it might be repayment to the customer, but for me it's amortizing a financial asset. And we are going to use the PPMT function. And I just want those of you who are new to financial mechanics on this webcast to recognize that we are not normally big fans of these canned financial functions. But in this particular case, I think you can make an argument that it's as clear as the alternatives. I'm going to need a rate. I'm going to need to amortize a balance. And crucially, what I'm going to need is some sort of, I don't know what, remaining periods of loan amortization. Now, the only reason we're using the PPMT is on an expectation that under FRS 5, which you'll remember was the basis upon which we're going to do today's webcast, the accountants presume a level debt service based amortization profile on the customer loan. Interest plus principal is flat in nominal terms. Okay, so that, if you will, is the answer to the loan term related to the repayment profile, which you will remember from the slides. And it's a good opportunity to use some flags, I think. We've got a concession period flag up here we use. And I really should hop back, I think, and do a proper job of this. So let me go ahead and take a look at this last concession flag and use that kind of to bootstrap myself up with this remaining period calculation. So here I've just brought in that flag, which is a 1 in the last concession period. And if I kind of think in terms of looking out here, what I'm getting at is that if that flag is equal to 1, and I'm in that last period, so I'm deliberately modeling out here all the way out here in column AZ, if that flag is equal to 1, there's one more period left to amortize the loan. The accounting rule under FRS 5, 99% So if that flag is equal to 1, it'd be 1. Otherwise, what we have is the next, if you will, calculation plus 1. So we're going to create kind of a reverse counter. And if I copy that back and kind of through this line, okay, and this, don't forget, is kind of, I'm trying to come up with a decent calculation for this remaining periods here, where we get some kind of, well, why don't we do what our skills would tell us, right, which is to chart this. And you'll see my problem with this is not only do I have some counter numbers here before my forecast starts, but also this sort of rubbish here at the back end is not particularly compelling. So that's largely why I've decided to bring in that second ingredient. We're going to edit up that formula and shoot this across, meaning I'm just going to multiply it by the concession flag, okay? So that I get a counter that now kind of just cleanly makes sense. It kicks off with 40 periods to go. Don't forget that's a semi-annual model. We have a 20-year sales contract that drops itself down, and in period column 43, I suppose you'd say, in this model, we have 1 period left to go. Okay, so we get to use that, and that somehow, if you will, is the third main ingredient we'll need for this PPMT function. And I always kind of forget what order these things are in, but we'll let Excel tell me here in a second, because it's not an analysis toolpack function. And in Excel 2003, we get the tooltips for these fellows. So the rate is a non-varying 9%. I've currently just sort of jammed on this sheet in a couple locations. We'll contend with that here in a few minutes. So we got half that 9% every period. The period argument basically is just saying which of the stream of principal amortizations do you want to take, and we want to take the first of the series. Number of periods left, effectively, so that's the number of periods over which that amortization is going to occur. And the way the sign convention works with this function, it's not that obvious from the tooltips, but you need to kind of treat the loan balance as a negative figure if you expect this thing to behave itself. And I'll let you guys read the function help on the optional arguments there. And what you'll see is that we have it's unhappy with 0 for the remaining period. So I'll just switch the order in this block here real quickly so that we're listing our ingredients in order that they occur within the function argument. So you might call this kind of the hash num. Okay, no reason to overcomplicate that formula. We typically wouldn't. But what we want is probably only to look at calculations being valid during the concession period, during the period of the sales contract or the concession that was let by the government. So we're going to create the, if you will, the good one, the one that doesn't have the hash nums. We're showing very clearly that this one has hash nums. I suppose it's worth putting a row total on that. So if the flag is equal to 1, we'd expect to take these numbers. So if we got hash nums within the concession period or any Excel error, we would like that to kind of carry on. But outside the sales contract period, we would expect to essentially have no principal amortization. Now, we do a row total on this. We have a number that's not particularly compelling because we have a $200 million customer loan. We're not expecting to repay or amortize $721.2 million here for our row total. But of course, it's nonsensical until we actually show that balance reducing over time. So let's create a leakage or a corkscrew that we set up a few minutes ago. When we do Shift F9 here, we get the behavior that we're hoping for. And if I look at the profile of the balance, which I think is an important thing for everybody on this webcast to be pretty comfortable with, you get that traditional bowed out picture, implying that the amortization accelerates. Now, for most of those who have kind of home mortgages and stuff, we're kind of aware of the fact that at the front of our mortgage term, if you will, we're pretty much just paying nothing but interest, but things accelerate. We kind of make more progress, if you will, on paying the loan as we get towards the end of our mortgage term. The other thing I suppose that's worth noting is that this increase on the balance would be some sort of further capitalizations to the customer loan. Well, we'll say customer loan, financial asset. And that was one of the topics that we are deliberately leaving out of today's webcast in the interest of simplicity. Is any further additions, if you will, we could pick that up on a subsequent session. Now, this line here has been put into the financial statements. Okay, so we've done trace arrows on that. The dependents of that are sitting on the financial statements at row 24. There's my asset balance. Okay, so that's been exported. And also as this interest income. Okay, so if I maybe change my zoom just a touch here so that you guys can kind of see a little bit more of the screen. I'm always reluctant to go to 75% because of certain characters that don't show up. We can see the kind of two red lines. We've got our interest income and we got our loan balance on the financial statements. Customer loan amortization itself is not, if you will, accounted for, does not present itself in the financial statements. It's not income. But what we need to ensure is that we are not including it as income either. So if we think in terms of this idea that we have widget invoices currently sitting on the P&L, the income statement for us Americans, for those of us who are Americans, I think that's what, we Americans? In any event, this widget invoices is the total effective cash that we're getting from the customer. He is expecting to pay for his interest and principal from that amount. So the residual amount service related invoices. Okay, so this is the amount of money that he's paying for us to sort of operate the widget plant. Don't forget, we sold the plant as an asset. The customer still wants us around to run the widget plant. So he's going to pay his interest and principal from that. And we're going to take these two bits off, both effectively debt service, if you will, right? Interest and principal or amortization subtracted from that. So very simple formula based upon these ingredients. Okay, leaving me with this concept of residual service related invoices. And it's this fellow and not the total widget invoices that is kind of left over that we haven't yet booked. Because don't forget, this fellow, customer loan interest income, we have added into the P&L. We've decided that customer loan amortization is not an income line, so that what we're left out of from the widget invoices is only this bit. And this is the bit that the accountants do allow us to put above EBITDA. We'll take a look at how this changes the kind of presentation of things. If I get that done, and I do a full recalc of the model, we're a lot happier with the results. See if I can get everything on the screen reasonably well here. We've got a balancing balance sheet, which, is a victory. And you'll see that from a balance sheet perspective, what we've done is we've changed ourselves over to this concept of customer loan balance. So that's changed, the fundamental change, if you will. We've sold that fixed asset, no longer have ownership or title in it in some sort of hypothetical way. And the P&L has changed. First instance, pretty simple stuff, that we've got this customer loan interest, which is brand new, no depreciation anymore. And then the residual amount left of the invoices that is honest to God revenue sits up here. And that's kind of a quick summary of, if you will, the new lines that that have come in here to cause the sort of new presentation. And you'll notice through all this that I didn't even look at the cash flow. All of this is a hypothetical, if you will, vision from the accountants, and not something that is physically changing the commercial nature of our contract with the customer. As far as the customer is concerned, all he's doing is just continuing to pay $60 or 65, whatever the number might be, per widget indexed over 20 years. He's not even aware this transaction has occurred. It wasn't his idea, it was the accountant's idea. So, how are we doing on our checklist? We got interest income calculated. We calculated our loan repayments, or if you will, customer loan amortization. We calculated our residual service invoices. We got a balancing balance sheet. And last, but certainly not least, we need to make this look a little bit more credible. And if we're presuming finance debtor or FRS 5 treatment, which we have been, that's the sort of basis of this PPMT level debt service sort of amortization plan, we ought to fix up our labeling. So let's just have a quick look at calling this, I don't know, we could call it FRS 5. So that's really what this fellow is at this point. And customer loan is now finance debtor. So there's the British accounting standard. We got 9 replacements on that sheet. Kind of move on through things. Do a shift F9, and then when I look at my sort of polished up financial statements, we have finance debtor interest income and a finance debtor balance as a long-term asset, a long-term financial asset on the balance sheet. Right, good stuff. Now, how does all that affect the accounting profit? Profit before tax, which is kind of the line that we're going to focus on primarily. Let's compare, if you will, the fixed asset position with finance debtor. And what I've got is a solution model where I will do a, let's see, print preview here just because I've got some kind of simple pages set up. And here's our starting point. Okay, green line, invoices, kind of ramping from somewhere between 15 and 35 million over a 20-year concession sales contract, if you will. Operating costs, dark gray, interest expense on our debt. Okay, so that has nothing to do with the financial asset. This is our liability interest expense, if you will. We also have this flat orange bit, depreciation. I've kind of deliberately put first here just to sort of show that that's a straight line depreciation over 20 years. So all of the rest of it, because we have a very simple model here with only those expenses in it. So the rest of this area is profit before tax. There's where we started. Where we move to can be looked at in a couple different ways. One way we can look at it is to take a look again, still at that green invoice line, and remind ourselves that those invoices were basically cut into 3 parts. We have interest and amortization on the financial asset. You see how I've stacked those two together, and here you've got that flat level mortgage style, if you will, FRS 5 type of treatment. And anything that's left in this blue hatched area is that residual service income. So the 2 blue bits are really the only elements that go to the profit and loss statement. If you will, the orange bit, which is kind of like depreciation in the sense that it is excluded from the income statement, whereas the depreciation is actually a physical subtraction, if you will, under fixed asset accounting. Okay, so this is the makeup of the invoices from the customer under financial asset accounting, FRS 5. It's one way to look at it where we kind of focus on those 3 parts. Another way to look at it is to stack it up in a sort of similar way that we looked at with the fixed asset, where again, nothing has changed with the operating costs or the interest expense on our debt. And essentially, the only bit that's missing, if you will, from the income statement is this finance debtor amortization. I don't really want to emphasize that it's kind of like depreciation, but it has the same effect, if you will, in some sense on what ultimately happens with the profit before tax, this checkerboard green area here in the middle. The difference, of course, is that the profile of that amortization with that kind of acceleration that we talked about on our loan is not the same, and that causes a different profile of the profit before tax between the two. And I think you guys can see fundamentally, I mean, here on the fixed asset, we were barely earning any profits at all, and we had a very steep climb up to about $20 million of PBT at the end of the concession. Whereas with the financial asset treatment, we do have some materially positive profit before tax at the front, but substantially less, about 15 million if I look at the gap there at the back. And to look at those two lines together with the fixed asset profile kind of charted here in the green line and the blue financial asset, you can see not only is there a crossover, but as we'll talk more about here in a few minutes, the area that the financial asset sits underneath, if you will, fixed asset here at the back, where it kind of loses ground to fixed asset, is the same as the area that it beat, or that we front loaded profit before tax or accounting profit at the front of our sales contract. And this is a pretty typical result of a shift to financial asset accounting. Front loading of accounting profit at the front of the contract period. If we were to take a look at a particular snapshot, if you will, income statement comparison here at the front, September 12 in this sort of cameraed set of table objects here that we've got here on our dashboard sheet. This allows us to kind of forensically drill into this issue of at the front, the profit before tax being higher. You can see I've highlighted the 4.3 versus the 1.4. And essentially what's going on is if you take a look at the two booked income components above and below EBITDA, adding up to $15.4 million, they are 2.2 million below the 17.6. So there's essentially 2.2 million missing from the invoices, i.e. the amortization of the financial asset. That 2.2 missing amount, if you will, is smaller in absolute value terms than the explicit subtraction we have for the 5 million charge for depreciation. So that 2.2 versus that 5 is about 2.8, and you can see the gap, subject to rounding, being about $2.8 million, meaning that we've got some acceleration of income at the front. That compares, kind of similar, if you will, plan of numbers to the next camera object here further out into the sales contract, September 2028 sort of semi-annual example here, where the total booked financial asset income of 22.1, 2.1, so help me out here, 24.2 million is underneath the 32.9 million by my math straight here. I think about 8.6 million. So we're underneath. We've got a missing amount of income, if you will, meaning we've got these invoices out to the customer, but $8.6 million of it we are not booking as income. That is more, again, in absolute value terms than what the explicit straight line depreciation charge is here, to the tune of about 3.6. And you can again see, subject to rounding in the last decimal, assuming I have my maths right here a little bit in my head, that difference, where at the back end we make it up. And what I mean by that is, if we were to look at the over life totals, you get this picture, where the overlife profit before tax of 390.8 million in both of our financial model runs, whether we're treating it as fixed asset or financial assets, is no different. What is interesting is that the EBITDA is completely restated. Okay, so do not think that there's going to be some sort of immunization of your EBITDA, because much of the income is booked underneath, and there's none of this, if you will, accounting depreciation charge. So you can see the massive, if you will, restatement in the organization of the income statement between fixed asset and financial asset. But over life, we are not manufacturing any additional profit before tax. And essentially what's going on, of course, is that the accounting depreciation charge over life of $200 million, which was the book value of the asset, was the same as our hypothetical transaction where our customer purchased the asset from us for $200 million, and we gave them a loan of that face amount. So this whole picture relies upon a sale at book value. No recognition of any profit margin on the sale of the asset. Worth keeping in mind on subsequent sessions as we look at other accounting standards. So how have we done? If I go back and kind of look at my checklist in this comparison between fixed asset and finance debt, or more broadly financial asset accounting, we looked at the different profiles over time. We took a look at those representative years. We commented that generally speaking, the financial asset treatment is going to front load profit, and the example that we have is pretty typical in many ways. It does beg the question, is this good or bad for our company? Kind of a quick assessment would be, well, I mean, generally having positive things happen to you in the near term and deferring bad news for as long as possible, meaning the lower profits, is a good thing. And that would be concretely good, particularly if you had some sort of profit restriction problem that was preventing you from getting cash out of the company in the form of dividends. So you get a positive cash effect. But the caveat on that good plan, if you will, for the move to financial asset accounting has to do with tax. Because nobody likes the sound of a statement that comes in that basically says, we've front-loaded your accounting profit, and because tax follows accounting, we've front-loaded your tax payment. See, that last statement doesn't sound so compelling. So we do want to be careful, and it does depend on the particulars, if you will, of the company's position, and we'll handle that on subsequent sessions. This over-life profit comparison, we looked at that equivalent over-life profit before tax. I think the numbers, what were those numbers? Numbers were 390.8 and 390.8. Just to sort of end on a low note today, I thought I'd run some just quick algebra, mostly so you guys who have access have this sort of framework, sort of quick algebra. But if I look at profit on the fixed asset, just a real simple reflection of the income statement. This N for invoices. So invoices minus operating expenses minus bank interest minus depreciation. That's a pretty simple representation. As a matter of fact, it reflects what we've looked through today on today's session. Gives that some variables, VO, B, and D. B for bank interest. I want to make sure I don't confuse this with other forms of interest income. D for depreciation. So expression 1. If I look at profit on the financial asset, you'd say, well, we have that residual service invoice element minus the OPEX minus bank interest. So those two didn't change. Plus interest income on the finance debtors. I'll call that FD interest. That residual service invoice, in turn, could be reflected. You remember that chart where we looked at those three components as subtracting from the invoice the interest and amortization of the finance debtor. So there's that debt service. That's how we calculated it. You'll remember that from the financial model walkthrough. And if we look at this, the finance debtor interest is kind of sitting in two places, such that that expression will simplify down to the invoice minus finance debtor amortization minus O minus B. So you start to see almost by inspection what's going on here, that the profit will match these two expressions, 1 and 2, when simply the total depreciation is equal to total finance debtor amortization. And this picture will hold true for any given period. I mean, that's the advantage of this algebra. It basically says that accounting profit will not be different in any period or over any period of time if the depreciation is equal to the finance debtor amortization. So what that implies is, just in theory, if you were to have the accountants stipulate that the repayment of the customer loan, and therefore the amortization of your financial asset, were to happen on a straight line basis in even principal installments, you would see no change in the accounting profit profile. We would still have significant variation in how EBITDA was presented. So you have to be careful if you're shifting over and just taking these numbers, you Corp Fi guys doing your valuation multiples. But the profit profiles would not be any different. So with a difference in the profile of depreciation versus the profile of the finance debtor amortization, we have a difference in the profile of the profit. That's about it for today. I'm going to go ahead and post up this slide pack, which will have some reference slides, and you can kind of use that to sort of recap the main themes and some additional stuff. But I hope that was helpful. I'll let you guys get back to the job and look forward to you on subsequent sessions.